The RBI Monetary Policy Committee, the MPC, has maintained status quo on interest rates. It was largely expected. It's the 9th time in a row now that the key interest rate, the repo rate, has been maintained at 6.5%. And the RBI Governor, Shaktikanta Das, has spoken about how persistently high food inflation could play spoil sport for the core CPI number. And referring to the Indian banking system, Governor Das has shared how funding has become a challenge for banks. He's saying that there is a need to review the norms when it comes to home loans. Listen to what he said in that media conference that took place.
As the regulator of certain segments of the financial sector, it's our responsibility to point out the possible or the potential areas where risks may come up. The second point which I would like to mention is that the sectors in which preemptive regulatory measures were announced by the Reserve Bank in November last year have shown moderation in credit growth. However, certain segments of personal loans continue to witness high growth. Excess leverage through retail loans, mostly for consumption purposes, needs careful monitoring. The third issue that is attracting our attention is home equity loans or top-up housing loans, as they are called in India, which have been growing at a brisk pace. Banks and NBFCs have also been offering top-up loans on other collateralized loans like gold loans. It is noticed that the regulatory prescriptions relating to loan-to-value, that is LTV ratio, risk weights and monitoring of end use of funds are not being strictly adhered to by certain entities. Such practices may lead to loan funds being deployed in unproductive segments or for speculative purposes. Banks and NBFCs would therefore be well advised to review such practices and take necessary remedial action.
So there is certainly a red flagging when it comes to top-ups on home loans that the RBI governor has spoken about. But let's get perspective on the rate decision and what the overall commentary has been. Independent economist Saugata Bhattacharya is joining us on this leg of the show. Great to have you, Mr. Bhattacharya. While the RBI governor has highlighted that the food component of retail inflation remains stubborn, give us your assessment from your own data points and what you're hearing from the commentary from the RBI of the risk that inflation still poses to the Indian economy.
So first, thank you very much for having me on your show. I thought the governor's statement and the MPC statement were a little bit more hawkish than I at least had expected. I had expected, although no change in stance, but the tone of the statement would be a little more dovish in recognition of the various the fears, the concerns that is now coming to the fore from the global markets. Instead of which, I mean, the MPC seems to have doubled down on food inflation. They are very, very clear now that until food inflation comes down on a durable basis, not just on 1 month or whatever, and this relates primarily to vegetables. That we have seen to a certain extent cereals, they are not likely to come down. I mean, even if core inflation, the non-food, non-fuel core inflation remains moderate at less than 3%, at 3% or thereabouts, they are not going to let go of the tight stance of monetary policy. So this was, I think, I mean, we were expecting at some point in time during the year, say December or February, at the policy review meets, that there was a potential for a rate cut. But given the forecast that the RBI has put out, they have actually increased the Q2 numbers to 4.4 and the Q3 numbers to 4.7. And given this, the probability that I see, if those forecasts turn out to be correct, I see the possibility of a rate cut in this fiscal year, not just in the calendar year, to have been pushed back to a very significant extent, which is a fairly hawkish take on the evolving inflation situation.
Yes. In fact, a lot of feedback coming in from the commentary about the hawkishness this time around, but also this divergence that lenders are facing between credit growth and deposit growth, something that the RBI governor has alluded to. How large a threat do you think this poses to the financial stability that the Indian economy needs right now?
Well, to a certain extent, the governor mentioned that this poses some structural liquidity risks in the system, by which he means, he hasn't spelled it out, but which I presume that means that banks resorting to, as he said, non-retail short-term loans, wholesale bulk deposits, which are more vulnerable to moving out. So as you remember, the RBI has actively tackled this with raising the LCR rates on multiple such such deposit components, particularly digital savings, digital deposits. That's an attempt to try to push banks more towards more sticky retail deposits. So that is something which is a structural problem, because remember, while as he emphasized that the banking system remains very stable, and I think it is, if there is some shock that comes into the system, the potential in an interconnected system for contagion to spread quickly through the system, that remains a regulator's basic nightmare. Remember what happened with the Silicon Valley Bank. That's a completely different regulatory story altogether. India is much, much better regulated. But that gives a cautionary signal to regulators to try to clamp down on any such potential occurrences coming in. The risks spread very quickly through the system, particularly in a network system like banks, like financial institutions. I think that's the key potential.
Yes.
So as Governor mentioned, I mean, many of the very rapid, fast-growing credit segments, particularly retail loans, unsecured retail loans, etc.,
Yes.
those are moderated.
So the question, Mr. Bhattacharya, is about the quality of retail loans. There is a nudge for better risk assessment by the RBI, and the RBI has suggested that deposits emerging from household savings through innovative instruments, now that would be a good idea for banks, and that's where they're leaving it. But why the focus on these aspects? How does it compare to the commercial credit offtake that we have today in India, the kind that we need to see capex grow in the private sector? How healthy does that comparison look between retail and corporate loans?
So you're absolutely correct that, I mean, the focus has to be on loans to the, as you mentioned, loans to the productive sectors of the economy. The numbers that we have seen, the end of June figures from the sector credit, loans to MSMEs in particular, which is likely to be a large retail drivers. Remember, loans to the large corporates or even the large medium corporates, that's not likely to grow very much, because, I mean, these corporates are so cash rich, they actually don't need too much bank credit. It's the loans to the MSMEs, which will be a very key feature. But unfortunately, the retail credit components are still growing at about 23%, 14%, 17%. Various components are still growing faster than the MSME component, which is still talking about 11, 12% credit growth. I think that's the focus of the regulator, to try to shift some of the deposits that the banks are getting, and presumably more sticky deposits into some of these MSME segments, by increasing risk weights, increasing LCR norms, etc., on both the asset and the liability side. I think that's the focus. To my mind, loans to the MSME sector still needs to increase even more.
So if that doesn't happen, Mr. Bhattacharya, how much do you agree with the projection for growth by the RBI for the economy? It has pegged FY25 GDP at 7.2%, leaving it unchanged this time around. But for that kind of target, how much does our corporate loan uptick need to happen as far as the Indian economy goes? How necessitated is it at this point in time to meet that kind of target?
So that's a fantastic question. So as at the beginning, I tend to think that the RBI's forecast of 7.2% real GDP growth is a little bit on the higher side. I would tend to agree with the economic survey's assessment of a 6.5% to 7% growth as a bit more realistic in terms of what we see in the economy in FY25. So assume a 7% GDP growth on the higher side, and say about a 4 4.5% inflation, that's about 11 to 12% nominal GDP growth, you would tend to expect that bank credit growth will be about, system credit growth will be about 1.2 to 1.3 times, which would tend to imply about a 13, 14, 15% credit growth, which is lower than what the 15, 16% growth that we have seen in FY24. So that's the number that we are looking for. If that is the case, if we actually get about a 14% nominal credit growth, then deposits would probably need to rise by at least 12 to 14%. Deposits are much larger than credit. So deposits would need to rise by 12 to 14%. That's the basic computation that we are going with. And that, to be able to meet that largely through so-called CASA, the current account, savings account, retail term deposits, etc.
Yes.
That would need a lot of focus, including higher interest rates on deposits from banks.
So if the RBI has to keep the growth momentum going, are you expecting rates to be cut before we hit the larger festive season this year? And if so, by how much, Mr. Bhattacharya? How do you see the pace of rate cuts happen?
My sense is that we are not going to get a rate cut in October. Remember, so one of the key factors determining the timing of India's rate cuts will be the Fed, the US Fed. Whether we do say that domestic factors are important, but the Fed is particularly important given the fact that the rupee has tended to depreciate in the last 7-10 days fairly sharply. So you will not be able to cut rates in India before the interest rate differential between the US and India still remains fairly small. So we'll have to wait for a Fed rate cut. That is almost a given now in September. So my sense is that October, the difference between 17th, 18th September and early October is still too small.
Right.
So my benchmark, my baseline sense is that the rate cuts will not happen at least before December, if at all, if then.
All right, fair enough. You think we'll have to wait for December until, of course, things change and a lot is moving even as we speak. Saugata Bhattacharya, such a pleasure having you on India Tonight. Thanks for joining us on ET Now.
Thank you so much.
That's the Economist perspective, but let's get you an industry perspective. Banking veteran Keki Mistry is joining us. He's the former vice chairman and CEO of HDFC, and now, of course, he's also an independent director with several companies. Mr. Mistry, always good to have you on the show and getting your perspective. The RBI governor, I was just discussing this with our Economist friend, but of course, Shaktikanta Das once again highlighting the heightened risks in the unsecured lending segment, and he's advising lenders to exercise caution when it comes to extending personal loans for consumption purposes. How significant do you think this concern is?
See, if you recall, sometime in November last year, RBI had voiced a concern on unsecured loans. And at that time, they'd increased the risk weight on those loans by 25%. And we've seen that the growth of unsecured loans in the system have come down from 30% plus to around 23-24%. So clearly there has been an impact. Now, obviously, RBI is seeing something which all of us or some of us are not seeing. So maybe there are some companies, maybe there are some banks, maybe there are some NBFCs, there is some concern that RBI has noticed in its inspection, and therefore it's giving some kind of a forewarning to the banks that be careful when you give these kind of loans. Typically, what happens is when someone takes a housing loan, after a part of the loan has been paid back, say 2 years, 3 years, 4 years after the loan has been taken, let's say the original amount is 1 lakh and let's say it has come down to 70,000 rupees because of repayment. Then the individual comes up and says, can I have a top-up loan? So the security of the property is already lying with the lender, and the customer comes and says, against that security, because my outstanding loan has come down, give me an additional amount. Now that additional amount is not really monitored very closely in terms of how it is used. So my sense is RBI's concern emanates from the fact that that additional amount which has been taken against the house is being used for perhaps consumption, perhaps for some unproductive purposes, perhaps for investment in stock markets. We don't know what the concern is. But that, to my mind, seems to be the concern.
So as far as concerns go, to a certain extent, it does seem valid. But from everything that you're pointing out in the way that it is working, Mr. Mistry, but with the RBI tightening norms, Could getting a home loan top-up become that much more difficult? And what kind of impact could this have on the growth of the home loan segment for banks?
See, in my opinion, the quantum of top-up loans in the system, at least I'm talking from the old HDFC experience, was very minuscule, extremely minuscule. And the reason is that if you are lending money to a typical middle-income customer who by nature is a very conservative individual, he will never want to go and borrow more money just because there is a security and he can go and borrow money. It never happens. It usually doesn't happen like this. Now, maybe with some segment of the market, maybe with the self-employed customers who may be using the additional amount they borrow for their businesses, it might be happening. So I think that is where the concern is. I don't think it slows down the growth of housing loans in the system at all, not at all. But those people who are taking these top-up loans because they paid part of the loan and now there is an additional security against which they can borrow money, there might be some constraint on them. Now, what RBI will do, we don't know. Maybe they will increase the risk weight on the top-up loan component. I don't know how it will work.
Yes, typically, Mr. Mistry, we've seen the RBI watch the situation for some time and then gradually come out with measures. But we'll see how that works this time. The governor, Mr. Mistry, has also emphasized the need for lenders to carefully monitor personal loans after the loans have been disbursed and also to ensure rigorous assessment, calibration of underwriting standards is something else that he pointed out. So this kind of due diligence, it could potentially increase overall cost for lenders, you think?
No, to the best of my knowledge, from whatever little I've seen with some of the banks or even Poonawalla FinCorp or some of the other NBFCs that I know of, I think there is a very good and proper and a very systematic diligence that is carried out before a loan is disbursed. Now, it is possible that with some particular entity, maybe RBI has noticed in its inspection that the diligence is not being carried out that systematically. It's possible. And maybe this is sort of a intimation to those entities. But by and large, in the system, I don't think diligence is not being done properly. I think diligence is being done very, very carefully, by and large.
Fair enough. Fair enough.
No, and I think that's cost. It's a very important thing. Yes. You have to do diligence. Without doing proper diligence, you're taking a risk on the entire loan.
There's no taking away from the fact that diligence is an important piece in the entire banking system. But does the increasing trend right now, Mr. Mistry, in the personal loan segment, does it indicate a shift in consumption patterns? Or do you think this could be a sign of some underlying concerns in the economy at this stage?
No. I think it is, to my mind, it is a shift in consumption trends. We have to understand what these personal loans or loans against properties or those kind of loans are being given for. There are different purposes. You could be borrowing money against a property for your own business purpose. So you want to put more capital into your business or you want to make more investment into your business. And whoever is lending you money will say, give me a security. So you give a property as a security. So that could be one aspect. Another aspect could be, and this is very common in the Western world, is you could be borrowing money for consumption. You could be borrowing money for buying things to put into your house or for some kind of revenue expenditure. In the Western world, it is very common that people would take a loan and then go on a holiday with the money that they get and then pay it back over the period of time. We've not seen that in India. I don't think the Indian mindset is such that people will borrow money in a big way for consumption. Yes, it may be happening in a few cases, but I don't think it is a widespread sort of thing in India. But in the Western world, it's very rapid.
Mr. Mistry, thanks indeed for joining us with your perspective on this. And of course, there are several questions that we still have and we will keep raising them as far as the RBI's move is concerned and more importantly, the commentary that has gone out today from the RBI governor.
If you like this video, then like, share and subscribe to ET Now.